Taking a look at your local markets now. Now, the JSE got a negative handover from Asia. That downbeat sentiment also just filtering through to the JSE. The strong U.S. jobs numbers also weighing on sentiment here at home and elsewhere across the globe. As you can see, the JSE mostly in the red, the all share down close to 0.33%. This mainly being fueled by losses in the financial 15, losing just over 1%. The industrial 25 down 0.57%. Back in the overall trend is the resources 10 complex up 1.5%. Joining me now as we delve deeper into the factors influencing those market moves is Cobus Potgieter from Southern Cross Capital. Cobus, thanks so much for your time today. So let's start with that all-important U.S. jobs print coming in above expectations at 265,000 jobs being added there in the U.S. economy. This, of course, versus the expectations of 160,000 jobs. Take us through your initial reactions to the move.
Well, numbers far more robust than the market expected. I believe, according to Bloomberg, there was a single economist that called for a number even close to this high. Wow. Essentially, we've seen a very, very robust job market in the US all year, and there was a feeling that there would be a bit of seasonal cooling. And even though we saw this kind of number a month ago, there was the expectation for it to halve down for the month of December. And quite significantly, of course, in tandem with that, the increase in payrolls is essentially the number of jobs being added, right? The unemployment rates also dropped by 10 basis points, better than expectation. And essentially what this has done is it's poured water on any prospect for a rate cut. Essentially, the Fed has two mandates, unlike the SARB. It's got an inflation focus and it's got a fiscal focus. Now, if inflation is not benign, because it isn't, it seems to have bottomed out a while ago and it's picking up a little bit. So that's quite concerning. And on the fiscal side, we're seeing a very robust labor market, a very healthy economy. There's simply no reason to continue cutting rates. So for Main Street, this is great news. The man on the street is probably more likely to be employed in the US. But for Wall Street, this is tough because the market seems to have front-loaded a bunch of cuts, and now the likelihood of a cut before October seems very, very low.
So would you say we're in for a hold come January the 29th?
Yes, absolutely. We've already had two of the members of the Fed effectively indicating that is what they will be voting for, saying that current rates are fine. We seem to be more or less controlling inflation, and again, the economy is firing on all cylinders. So they seem to be comfortable with holding at this level for the foreseeable future.
Let's get into some company news now. TSMC delivered record revenue in the fourth quarter, of course, benefiting from the AI boom. Surely this doesn't come as a surprise, Cobus.
It comes as a surprise in terms of the quantum. Okay. They beat the expected record results by more than 5% for the quarter, which is absolutely phenomenal. So that's a really good set of results. And I suppose in the wake, if you were going to play the during the gold rush, sell shovels, not don't try and acquire mines. TSMC was, of course, that approach. It's a little bit more complicated than that, but they are reasonably manufacturer agnostic. They actually are providers to all of the competitors in the GPU space producing these chips that are used for AI, and they are the preferred vendor for NVIDIA in particular. So that's worked out particularly well for them. And despite some, call it policy headwinds, they've benefited massively from the AI boom.
Let's get into the rand quickly. It's pushed past the 19 rand mark to the dollar. It really does seem like a dollar story here because we are seeing lots of dollar strength. How low or how weak do you expect the rand to go, particularly because we are waiting for those Trump policies to come through?
Yes, this is a tricky one. Look, the market's sitting in the sort of limbo
Yeah.
between what Trump said he was going to do and what now the rumors and the insiders are indicating he's going to do. It sounds less severe than promised, but again, a populist does everything on a short-term basis to score political points, right? So sometimes he might take more severe policy stances than the market is hoping for, even though he's indicated very severe policy stances. This is very difficult to interpret. But we do need to sort of be cognizant of the fact that the rand isn't all that weak. The dollar is incredibly strong. The two worst performing currencies of the day today is in fact the rand and the Brazilian real. And that is quite frankly because those two currencies are the two liquid emerging market currencies that serve as sort of proxies for EM in general. And EM is very quickly going out of fashion from a global investor's perspective. You know, again, the Trump presidency introducing a lot of uncertainty and potential tariffs, which will hurt the emerging markets. On top of course, a relatively strong U.S. economy being a more attractive investment destination. But just to frame that against last year, the rand was the best performing currency in the world, other than the dollar. So we're not coming off that poorer base from that perspective, and maybe a bit of a sell-off was expected, but most of this comes down to somewhere between a flight to the US generally and some pessimism around EM going into the next portion of the cycle.
Cobus, we've run out of time and I would love to get your stock pick, but unfortunately I can't. But thank you so much for joining us and just taking us through the day's markets action. That was Cobus Potgieter from Southern Cross Capital.